Warren Buffett once said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And what could be more wonderful than the top 30 giants of the S&P 500? Welcome to the Value Verdict. This week we are diving deep into the 30 biggest companies in the S&P 500 to find out which of them are trading below their true value and which ones might be setting you up for a fall. Here's how it works. For each company, I've run two valuation models, a discounted cash flow analysis, also known as a DCF, which is a popular method of estimating the current value of a company based on projected future cash flows, and also a relative valuation analysis, which is another way to value a company by comparing it to other businesses based on certain metrics. And I've combined both to calculate an intrinsic value, the true value of each stock. We will compare that to the current market price and give each company a grade from A star to F, so you can quickly see which stocks might be a bargain and which ones to avoid. Let's get started. Kicking things off with Apple, I've put in the values from both the relative and DCF valuations on the chart. Some investors prefer the relative valuation over the DCF and vice versa, so I put both of these on the chart, and the intrinsic value is the average between them. Your entry is going to be based on your personal preference, but if you'd like to use values from both the relative and DCF valuation, or if you're not sure which one to use, then the intrinsic value could be worth considering, and it's also the value I'm mostly going to be using in this video. The stock price of Apple is currently 32% above its intrinsic value, making it overvalued, and it receives a grade E. Moving on to the next stock, which is Microsoft. Microsoft also currently looks overvalued. However, just a few weeks ago, it was around the relative value range, but at the moment it's above 42% from its intrinsic value level, which makes this overvalued as well, and it also receives a grade E. The next stock we have is Nvidia. The stock price for Nvidia is currently below the relative value by around 7%. So if your preference is to use the relative value, then this could be a good opportunity. However, for this video and for the grading, we are using the intrinsic value, and based on that, it is currently 17% above the fair value, giving this a grade D. However, the price was around the intrinsic value level, even going below it just a few weeks ago, so we could see another retracement and the price coming back to around this level at some point in the near future. So this one is going to be worth keeping an eye on. I will be making these videos weekly, so next week we can see if this does come down closer to the intrinsic value level. If you don't want to miss that video, then consider subscribing to the channel. Moving on to the next stock, which is Amazon. Amazon is also currently overpriced by about 29%, which is just enough for it to maintain its grade D status. The next stock is Meta Platforms. Similar to the other stocks we have been seeing, Meta Platforms also looks like it has become overvalued over the past couple of weeks. Currently, it's around 25% above the intrinsic value, making this a grade D. The next stock we have is Berkshire Hathaway. The price is significantly above the intrinsic value level by around 37%, which gives this a grade E. The next stock we have is Alphabet. The examples we have been seeing, the relative value has been above the DCF value, but that's not always true. Sometimes the DCF is higher than the relative value, which is what we can see in Alphabet. The price is currently slightly below the DCF value and slightly above the intrinsic value by just 4%. That means it's almost at a C, but as it's not below this green line, we do have to give it a grade D. If we do see a retracement next week, then we could be seeing Alphabet below this intrinsic value line like it was a few weeks ago. Moving on to the next stock, which is Broadcom. the price for which is again above the intrinsic value line by 52%, making this a grade F stock at the moment. Next, we have Tesla. So with Tesla, we can see this gray line here. And the reason for this gray line is because the relative and DCF valuation doesn't work very well with growth companies like Tesla. So we tend to not get an accurate valuation. So for growth companies like Tesla and Palantir, we're going to be using forecasts from Wall Street. And based on that, Tesla is slightly below by around 4%, giving Tesla a grade C. Next, we have JP Morgan Chase, the price of which is significantly below the DCF value and also below the intrinsic value by around 5%, giving JP Morgan Chase a grade C as well. Next, we have Eli Lilly. Eli Lilly is currently significantly above all three levels. If we use the intrinsic value, it's currently overvalued by 110%, which gives Eli Lilly a grade F. Next up, we have Visa. Similar to what we just saw with the previous stock, Visa is also significantly above the intrinsic value line by around 64%, which gives Visa a grade F. Next, we have Netflix. Netflix has been skyrocketing over the past few weeks, which makes it a bad time to enter. It's currently 137% above the intrinsic value, which makes Netflix a grade F as well. Moving on to the next stock, which is ExxonMobil. The price is currently significantly below the DCF value, and it is also below the intrinsic value. We are estimating it to be around 16% undervalued, making this stock the first stock that receives a grade B this week. Next, we have MasterCard. Similar to what we saw with Visa and some other stocks, this is currently significantly overpriced. It is 59% above the intrinsic value, which means it receives a grade F. So the next stock we will take a look at is Costco. Costco is also above the intrinsic value line, making it overvalued by around 105%. So it also receives a grade F at the moment. Moving on to Walmart, where we see a similar story. The price is currently 68% above the intrinsic value, making Walmart a grade F stock. Next, we have Procter & Gamble, which is also way above the intrinsic value line by around 40%, making this a grade E. Next, we have Johnson & Johnson, the price for which is in a better place than the others we have seen. It's currently below the relative value and also the intrinsic value by 4%, meaning it receives a grade C. The next stock we have is United Health. We have recently seen a huge sell-off, which is good for the strategy we're using. We're trying to get discounts. And this recent sell-off means that the price is currently below all three of our levels. When comparing it with the intrinsic value, the current price is 44% undervalued, which gives this stock an A-star grade. It's definitely worth considering this one based on how much of a discount it's currently available at. Moving on to the next stock, which is Home Depot, the price for which is currently above the intrinsic value by around 39%, which means we give this stock a grade E. So the next stock we'll be looking at is AppV, which was below the DCF level but has recently been skyrocketing, and that means it's currently 24% above the intrinsic value, making this a grade D. Next up, we have Coca-Cola, the price for which also seems to be overvalued currently by around 23%, making this a grade D as well. Moving on to Bank of America, which is looking much better. It is currently below all three levels. Going from the intrinsic value, we think it's undervalued by around 30%, making this a grade A stock. So Bank of America is another one you may want to consider if you are following along with this strategy. Next we have Philip Morris, the price for which is slightly above all three of our levels. Going from the intrinsic value, it's currently overvalued by around 28%, giving this stock a grade D. Next we have Salesforce. The price of Salesforce is currently below the relative value and also the intrinsic value, but still slightly above the DCF value. But since we're grading based on the intrinsic value, it's currently undervalued by 6%, making this a grade C. Moving on to Palantir. So similar to Tesla, Palantir is a growth stock. So the results we get from the usual valuation models can be a little inaccurate, which is why we have the forecasts from Wall Street, which puts the fair value of Palantir at around $92. The price is currently above this by around 35%, making Palantir a grade E. Moving on to Wells Fargo, the price for which is currently below all three levels. Looking at the difference between the intrinsic value and the current value, we're estimating Wells Fargo to be undervalued by around 22%, making this a grade A stock at this point in time. The second last stock we have is Oracle. The price for Oracle is well below the relative value line. It's also slightly below the intrinsic value line, but slightly above the DCF. We are estimating this stock to be undervalued by around 3%, which gives it a grade C. And finally, the last stock we are going to be looking at is Cisco Systems, the price of which has been going up in the recent week. It would have been a grade C stock a few weeks ago, but right now it's above its intrinsic value by around 5%, making this a grade D. Over time, we will be seeing the stocks that are currently overvalued coming down closer to their intrinsic value, and we will also be seeing the undervalued stocks making their way above the intrinsic value. And as that happens, I will be making update videos so that you can stay on top of which stocks are currently undervalued and which ones are overvalued. I'll be making an update every week, so if this is something you want to follow along with, then consider subscribing to the channel. The next episode will be coming out next week with the latest information. This strategy is known as value investing. We're looking to buy a stock when it appears to be undervalued. It is a good strategy, and another strategy that I like to use is tracking trades made by US politicians. Over the years, I've seen returns from value investing being better than other investing strategies, and investing alongside key US politicians has been even more profitable than value investing, so it's the strategy I use most of the time. If you are curious about how I do this and how you can too, I put together a free video on my website that walks you through how to use publicly disclosed information to find the most profitable trades. And I also go through the returns of this strategy over the past 3 years. The link to this video is in the description below, so feel free to check it out if you're interested. And before you go, if you found this video helpful, consider dropping a like on the video, as that would help out the channel a lot. And also, if you're new around here, consider hitting the subscribe button if you'd like to stay up to date with the series. And finally, it's also worth mentioning, I'm not a financial advisor and this is not financial advice. Please make sure you do your own research and your own analysis before you make any investment decisions. That brings us to the end of the video. If you would like to learn how to profit like a politician, then the link to this free video is in the description below. Thank you for watching, and I will see you in the next one.